Hello and welcome. In this lecture video, we'll cover the balance sheet, the pro forma balance sheet. So the balance sheet is typically the last budget that we will prepare. And that's something that we talked about in the first lecture video of the chapter, where we talked about the relationships among the different budgets. In order to do the balance sheet for June 30th, which is the end of quarter two, which is what we're going to work on the next page, we have to know the balance sheet for the end of quarter one, March 31st, okay? Some of this we need to know in order to do our balance sheet on the next page ending June 30th. So I will be flipping back to this. Okay, so let's go ahead and look at our balance sheet here for ending June 30th, which would be the balance sheet for quarter two. So we're splitting it out. This is a classified balance sheet. So we have our current assets, plant, property, and equipment, then total assets, liabilities, and then our stockholders' equity, and then the total. Okay. So cash, I'll write the number down. We get $43,000. And I'm going to put an A here. And over here, I'm going to say where I got that from. That is from the cash budget quarter two ending. So if you were to look back at the cash budget, you would see that we ended with $43,000. Accounts receivable, $75,000, and I'll put B. And that is from our schedule of cash collections, which was the budget that we did in a prior lecture video. That was right after the sales budget. And in that lecture video, recall that I asked you to calculate what is accounts receivable at the end of quarter two. And we calculated it out as $30,000. And remember, the way that we did that is we had June sales, 30,000, times 0.25, which was the amount that we were going to collect in the next month. And that's how we got that $75,000. Okay. Raw materials is $4,600. And I'll put a C here. And I'll put a C there. And that was from our direct materials budget. If you look back at our direct materials budget, recall that we had 11,500 desired ending inventory. Okay. 11,500 pounds. Sorry, let me move this up. 11,500 pounds in desired ending inventory at end of Q2. Now, that's pounds. We need to show dollars, right? Because this is the balance sheet. We don't show pounds on the balance sheet. We show dollars. So to get to that 4,600, we took 11,500 times our 40 cents per pound, which gives us our $4,600. Okay. And then our finished goods inventory, we calculated out at 25,000, and I'll put a D there. D. And the way we got that was from our finished goods inventory budget, or ending, I'll call it my ending inventory budget. So remember that we had 5,000 units in ending inventory at the end of the quarter and ending June, times my cost per unit of $5. And that's how we got that $25,000 right over there. And so now what we can do is add up all those, and we get 147,600, which is our total for our current assets. Now, land, we did not purchase or sell any land throughout quarter two. We did not purchase or sell any land throughout quarter two. In land, so land basically stays the same as it did on March 31st. It carries over. So land is my 400,000. Now with buildings and equipment, I'm going to put an E here, and I'm going to have to write it right over here. I'm going to explain how I got this number. And I'll write down the amount. And the way I got that number is right over here on March 31st. We have our buildings and equipment right over here. We did not sell any buildings or equipment, but we did buy some more. Remember, in the cash budget, we did purchase some equipment purchases in May, $143,700, and then also in June of $48,800. So what I do is I take my $1,610,000 plus my $143,700, which is my equipment purchases in May from the cash budget, plus my $48,800, which were my equipment purchases in June, and I add up all those, and then that gives me that $1,802,500. And that's where I got that from. F, which is my my accumulated depreciation, a total of $841,500. And let's talk about how we got F. So, as I mentioned, we did not sell any equipment, but we do have some accumulated depreciation right over here. So we're going to take this $750 that we had from March, and then what we're going to do is we're going to add in the depreciation that was from our manufacturing overhead budget. Look back at our manufacturing overhead budget, and you would see that we had total depreciation for the quarter of $61,500 plus equipment plus depreciation from our selling and admin budget equal to $30,000. And then that equals our $841 right there. Okay, so now what we can do is we can add the 400 plus the 1,802,000 and then subtract out our accumulated depreciation, and then that gives us our net plant, property, and equipment. Then we can add in our current assets plus our plant, property, and equipment. And then we have our total assets. Okay? Then what we can do is we can show our accounts payable. We had accounts payable, if you look back, and I'll put a G right over here. And then I'm going to have to flip the page over and write G down here. And we got G, our direct materials, from our direct materials cash disbursements. Budget. Okay, so remember what we had. We were going to buy $56,000 worth of direct materials, and that was in June. And then we paid for half of it in June and half in the next month. So our outstanding accounts payable, as we talked about in that budget, is equal to our $28,400, which is right over here. Okay? And then we can look at our common stock. We didn't sell any common stock. We didn't issue any common stock. So it stays constant at $200,000, which is from March 31st right there. Now, I'll put H by retained earnings. We need to calculate retained earnings. I'll come over here. So remember, the way to calculate retained earnings is we're going to look at our prior period's retained earnings from March 31st. Okay, and then we add in our net income, which is from our income statement of $188,200, but then we also subtract out our dividends, our cash dividends that we paid in April, which was from the cash budget. And then that gives us our total amount over here for our retained earnings. We calculate that. $1,280,200. And then we can add these two. $1,480,200. And then we can add the $28,400 plus the $1,480,200. And then we balance our liabilities and equity equals our total assets. And then our balance sheet is balanced. And everyone's happy and the world is good because it's balanced. Okay? This is going to end this lecture video. In the next lecture video, I'm going to go through and walk through an example for a merchandising company, budgeting for a merchandising company. These series of lecture videos that I've done up so far have been covering budgeting for a manufacturing company, and that's probably the harder way, is with a manufacturing company, because you have ending inventory budgets and you have manufacturing overhead. The merchandising is a little bit easier, so it's better to walk through the harder problems and then do the merchandising company, which is going to be a slightly easier budget towards the end of the chapter, okay? So the next lecture video will cover merchandising company budgets and then also some concluding remarks on budgeting. Thank you so much.